This week, the Reserve Bank of Australia's Monetary Policy Board left the cash rate unchanged at 3.6%. This was widely expected because last week's result for the September quarter inflation data was much higher than expected. It was a material miss on the RBA's forecasts and also higher than we had expected a few months ago. Now, the RBA could have been more hawkish in response to that inflation surprise, but they recognised that at least some of that stronger inflation in the September quarter was temporary noise. They have, however, taken some signal from the stronger inflation in some market services components and in housing-related inflation. And so they have also increased their forecasts a little further out. Consumer demand is expected to pick up from here, and the RBA expects overall growth to strengthen to something close to their assessment of trend growth in capacity. But they are worried about capacity constraints, and this is affecting their view of inflation. The RBA also assesses that the labour market is still a bit tight. But again, they could have taken a more hawkish view, given their assessment that September data on the labour force was perhaps a little bit noisy. They had previously been quite dismissive of that, but we noticed that they acknowledged that the labour market has softened a little, even though they regard it as still being a little tight. They also take some signal from other measures of the labour market, including job vacancies, business surveys, and the share of people who voluntarily left their job recently. And on that basis, they think that there is still some tightness in the labour market. This is also feeding into their view of inflation. But one way to think about the outlook from here is that when that noise in the September quarter CPI has washed through, and perhaps a little bit of that tightness in some of those components of inflation continues, we are nonetheless in a world where the labour market is not quite as tight as it was 3 months ago, and their forecasts are now built on a higher path for interest rates than they were back in August. And when you put the two of those together, you really would expect to see a downward slope to inflation that you didn't have in their August forecasts. And that is indeed what you see in their forecasts in the November round. So with the Reserve Bank assessing that monetary policy is still only a little tight, that the labour market is a little tight, and that inflation is likely to stay above the midpoint of the 2 to 3% target range, they are inclined to keep rates on hold until they see evidence that, in fact, inflation is back down towards and into the middle part of the inflation target. Now, our own view about the inflation outlook is that it could be a bit lower than what the RBA is forecasting. And we think that the unemployment rate will be a little bit higher. And so if things turn out as we expect, rather than in line with what they expect, you could see a bit more policy easing next year. We're expecting 2 rate cuts in May and August if things play out as we expect. Of course, if things play out as the Reserve Bank expects, then they're probably on hold for longer. But there is a risk there that the longer they wait, the more they might get caught out by an easing labour market and therefore have to do more. For the time being, though, we see the cash rate on hold for the rest of this year and for most of the first half of next year.
The content of this recording is informational and of general nature only and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.